Hi, I'm Jeff Mandel, the President and the CEO of the iQual Corporation and the ApprovalGUARD service. I'm here to present to you a quick credit tip to better help your customers. The good news is that the far majority of society has become much more concerned about their credit scores these days, especially when a better score can result in the following. First, qualifying for your home purchase, getting a mortgage, and other credit-related products, such as home equity loans, car loans, and credit cards. Second, receiving lower interest rates and monthly payments, as well as saving thousands of dollars in extra interest expenses. Third, getting a job, since most employers now are actually performing credit checks along with background checks as part of their hiring process. Fourth, and improved insurance premiums. However, the challenge is that the far majority of people really don't understand how credit works. Oftentimes, the actions that individuals take may actually harm their credit scores because of these misunderstandings. Let's take a recent client who we'll call Rachel for this example, who was reviewing her credit and decided to close her 8-year-old Visa credit card that had a credit line of $18,000. She hadn't used the card but once or twice a month and had 2 other major bank cards that provided rewards points. So to keep her credit clean, she decided to cancel the card. The next month, she found out that this one decision caused her credit score to drop 87 points from a 752 to a 665. Now, it's important to note that a 680 score used to help your customers qualify for the best rates and products. It's now 750 or above. This is just one example of a story which happens way too often, and it's typical for how most people manage their credit, which is by trial and error. Over a lifetime, many people build up a respectable credit profile. However, the same level of credit could have been achieved much earlier in life with the proper education and guidance. In general, a consumer credit score is made up of 5 key components. The first is payment history. Most individuals believe that paying your bills on time accounts for 100% of your credit score. However, it only is 35%. The second is the amounts owed. This accounts for about 30% of your credit profile. This includes the balances of your current loans, your debt to credit ratio, and the proportion of installments that you still owe. The third is the length of credit history, which accounts for about 15% of the credit profile. Next is new credit, and this accounts for about 10%. And this really includes items such as recent inquiries, opening new accounts, and those types of activities. And the last is the types of credit that your customers actually use, and this accounts for about 10%. The proportion of first mortgages, credit cards, revolving debt, retail credit cards, etc. In Rachel's case, the major bank credit card she canceled was paid on time every month for 8 years. She didn't use credit a lot, and this particular credit card represented the best contribution to the amounts owed and the length of credit history category. Although Rachel had 2 other major bank credit cards that offered rewards points, they were only a few months old and had only been used intermittently, giving them much less value on her credit score. Next to her mortgage loan, the 8-year-old Visa credit card was her most established and impactful form of credit history. Consequently, the other newer cards also had higher interest rates and yearly fees. The good news is that in Rachel's example, she researched the cause of her credit score decline, and with the advice of her credit advisor, she was able to improve her credit score back over 770. Contrary to popular belief, credit scores do not penalize you for having too much available credit. With this in mind, it's better to preserve your credit score by leveraging and maintaining your old accounts, which in this example provided 15 years of established and strong credit history, which is more important than having fewer and newer open accounts. Major bank credit cards have actually more impact on your credit than, let's say, a department store credit card. Although closing a credit card can greatly affect your credit scores, sometimes you may have no choice. It's also important to note that credit cards that are unused or rarely used can have their credit line actually reduced or may even be closed without your approval by the credit card issuing company. This can impact your credit score just as much as canceling the card yourself. Effectively managing your credit is very complex. When combined with the fact that the algorithms used by the credit bureaus often change, they are not consistent from one bureau to another, and an individual's credit profile changes all the time. Because of the continually changing dynamics of the credit landscape, combined with the complexity of how credit really works, it's critical that you help your clients more effectively understand how credit really works and that they should continually monitor their credit situation and profile. Let me tell you a little bit about the iQual Corporation. We provide advanced credit monitoring and advisory services that are focused on your customers' financial literacy and wellness through our branded solution, ApprovalGUARD. ApprovalGUARD helps your customers understand, evaluate, monitor, and optimize their entire credit profile, leading to improved credit profiles and credit scores of your customers, and ultimately helping them reduce their monthly interest expenses. You can learn more at www.ApprovalGUARD.com.